Conference Center. And before we start tonight's proceedings, I would like to ask for your first contribution. If you could please, you all switch your mobile telephones to put them on silent mode, please. I would like to invite the President and Managing Director,
International President of the ICS, Chairman of the ICS Greek branch, members of our panel, ladies and gentlemen, good evening. I would like to welcome you to the 10th Annual Forum of the Institute of Chartered Shipbrokers Greek branch. It's a great pleasure to see you all here tonight on this 10th anniversary of our opening ceremony.
When he was speaking, and it was to a crowd of senior citizens, and it was late in the afternoon, and some of the senior citizens, or one in particular in the front row, fell asleep. And after about 10 minutes, he started snoring. And the snoring got louder, and it started to become a distraction to the people around him. And he said, I think I have to do something about it. So he came off the podium, he went down, and there was a lady sitting next door to him, which he assumed was his wife. And he said, excuse me, would you mind poking him? She said, what? She said, would you mind poking him? She said, why? You put him to sleep, you poke him. So I'm assured Natalia that I will keep to my time limit, and hopefully it won't be any longer. My son asked me a couple of years ago how or what other industry I would like him to ship in. And that was a bit of a challenge. But after a while I decided that it had to be shipping. It had to be the film industry, as near as it could be to shipping. And why? Well, we've had good films like Mutiny on the Bounty, we've had Titanic, we've had Captain Phillips, and then we have a particular favourite of mine, which is a film that was made in 1966, and some of you youngsters might not remember it, but some of us old guys do. 1966 by Clint Eastwood, and it was The Good, the Bad and the Ugly. Why The Good, the Bad and the Ugly? Well, let me tell you. Let's start with the ugly. The shipping industry really does know how to do ugly, doesn't it? When you think about it. We've had Exxon Valdez, Open 90, DNA clauses, Sea Empress, Erica, Prestige, and recently Marina container ship. And then, of course, we had the kamikaze Italian pilot who decided to take his cruise ship on a sightseeing tour in the evening. But what has this actually done for us? They're all ugly incidents. And we have other ugly incidents as well, don't we? We have to contend now with terrorism, piracy. Piracy at the last count was somewhere between $4 and $6 billion a year. So that's a very expensive issue. But what does this all do? We get on then to the bad. In fact, the ugly. Now we look at the bad. This gave the industry a really bad name. And it's not surprising, really, when you think about it. All these incidents, the general public outside this room, out in the streets, thought we were unprofessional, uncaring, not sensitive to the environment. And I could put a few more onto that, but I know Natalia is breathing down my neck. Who were the accusers? Well, it's the legislators, the US Coast Guards, the European Union, court state control, our stakeholders, importantly. And let's not forget the media, who love a good story, providing it's black, thick, sticky, and leaking from a tanker of dubious ownership. The trading conditions are bad, they're really bad, and they're not going to get much better, unless, of course, we're told otherwise by our panel of experts here. Well, I wouldn't dash out after this and go and put some bets on, but that's just my personal feeling. So what is good? Well, the Institute is good. No, it's not. The Institute is very, very good. The Institute was formed in 1911, so we're just over 100 years old. And it was granted a Royal Charter in 1920, and a second Royal Charter in 1984. Well, the 84 one is probably the most significant, because at that stage it allowed us to invite overseas members from the Commonwealth and members outside the United Kingdom, to participate in our examination process. And currently over 4,000 members. We have 17 what we call distance learning centres, which is centres where they concentrate and actually preach the Institute's word on a local basis, and there's one here. And the demand for courses is rising slowly but steadily, but in the last 12 months it rose by 10%. Considering the lousy market, I think that's a pretty good achievement. The demand, in fact, this year has been so great that the council that controls the Institute decided to have a second set of examinations in November, which is November just gone. Not the whole lot, it's 16 subjects, but 8 subjects. This is a trial to see how it would go, and it went extremely well. And in the April examinations this year, we had 2,600 students, sat 6,400 examinations in 115 examination centres around the world. Now that takes some doing. You think all these papers come from London, they're sat, and all the papers go back to London to be marked. Now, the examination centres came from Mogadishu, Caracas, Vladivostok, Houston, Douala, Baku. Australia and New Zealand had 5 examination centres. South Africa has 6 examination centres. But at the same time, they also help out in Namibia and Zimbabwe. London has 11, but Greece only has 1. However, the good news is that Greece, as alluded by Matthew, has now taken over London as the top place, the top number of students, the top number of examination centres sat. An absolutely fantastic achievement. And this is the first time ever that London's been knocked off its pedestal, so you've got quite a task to keep yourself going. You had 342 students who sat 876 papers in April. This is a fantastic achievement, and I would just like to take the opportunity to congratulate everybody concerned, from lecturers to students. And Greece should be very proud of its students who have worked so hard and participated in these examinations. Thank you also to the sponsors, because without the sponsors, a lot of you wouldn't be able to do the examinations. So please continue to support your students. And if you can do more to support your students, that would also be much appreciated. The continual rise in the number of students and their increasingly diverse geographical spread suggests to me that professional qualifications are more important than ever to the industry's practitioners, and they want to be prepared for the market to recover. whenever that is. Right. Ladies and gentlemen, for the benefit of those who don't know me, I'm a passionate believer in professionalism. I'm a passionate believer in professionalism in the shipping industry. And I'm a passionate believer that the ICS has the right educational package to meet today's challenges. And one thing's for sure, Mr. Chairman, I certainly do not have that sinking feeling. Thank you.
To the 10th annual forum of the Institute of Chartered Shipbrokers, Greek branch. It's amazing that we've been coming up here for the last 10 years. Fantastic. We thank Mr. Bruce Allgiving, International President of the Institute of Chartered Shipbrokers, for being with us this evening to celebrate the 10th anniversary. We also thank him for his words of encouragement and appreciation, and of course for his traditional British sense of humour. And I think I'm right in saying that Welsh is British. Is that right, Mr. Oginitis? Right. Maybe it's not the right time, but I would like to ask the question, because you said so much about the history. Did the Institute admit women when it was first incorporated? It did. So the Baltic did not admit women, but the Institute did. Thank you very much. Ladies and gentlemen, I'm very proud of our branch accomplishments, during which time I have had the honour and privilege to have served as your chairman. It is particularly pleasing that many of our students passed the annual examinations with distinctions within a framework of transparent international competition. We heard here from Mr. Allgiving the huge figures, thousands of students with whom our students are competing. They are worthy of congratulations, as is their school, the Hellenic Management Center, the HMC, for the discipline and the education provided. This year, the Hellenic Management Center has become the official provider of the Queen Mary University of London LLM in International Shipping Law program, which will further enhance the opportunities for shipping professionals in Greece. That is remarkable. That's a remarkable achievement in itself. I would like to say to the HMC and to Mrs. Natalia Marioli in particular, I think I'm the first person to pronounce your name correctly this evening, Natalia. Keep up the good work in this well-managed school, and do not stop striving for excellence. That could be your mission statement. Turning now to the subject matter of our conference this evening, I will confine myself to saying this. Shipping is a risky business. We often get that sinking feeling when we reflect with disappointment on what we have done in the expectation that the market will turn out well, only to see it collapse before it can deliver the rewards hoped for. When will shipping rise again? Now that is the debatable question, but it is a tricky one, because the tanker market, for example, has already risen on the back of the recent sudden huge drop in the price of oil. But it is also tricky because there are so many variables that the outlook for most sectors of shipping remain uncertain. Shipping is always uncertain. Allow me to acknowledge our gratitude to the whole ICS Greek branch community, the Institute of Chartered Shipbrokers, the Hellenic Management Center, the administration, the teachers, the lecturers, the students, above all maybe, all our loyal sponsors, they make it happen, the Baltic Exchange, the British Embassy, the shipping industry itself, who have all supported us throughout this decade, enabling us to get where we are now, here. Before leaving the field to this truly excellent panel of speakers, a special word of thanks and appreciation go to Leonidas Eugenides Dimitriadis for hosting us here once again at the Eugenides Foundation. Last but not least, many thanks to Natalia Marioli and the ICS team for efficiently organizing and administering today's functions. Ladies and gentlemen, enjoy this evening's conference and celebrate with us the first 10 years. I take this opportunity to wish you all and your families a Merry Christmas and a Happy New Year. Thank you for your attention.
Rise again. This is the most important question for most of us. The when, of course, implies that shipping will rise, and it's only a question of time. It implies a cyclicality, and of course a lot of people, a few amongst us, have invested on this cyclicality, but the doubters are out there who think that shipping is now turning into a normal business with very poor long-term prospects and results. Is it so? Well, this and 30 or 40 other questions I have to ask tonight's panel, so please allow me now to call our first speaker, Mr. Michael Boduroglu, Executive Chairman and President of Paragon Shipping. Mr. Boduroglu.
Thank you, Mr. Chairman. Good evening. Congratulations to the ICS on your 10 years of life in Greece. The bull and the bear. Well, we all know that shipping is cyclical, but I'm not sure we understand, we explain cyclicality, we understand cyclicality the same way. I would like to give you my own understanding of cyclical thoughts with about how I see the future. This is the BVI over the last 25 years with the peaks and its troughs. And you know, you can see there the world events that are marking, that are reminding us of the troughs and the peaks. However, this is only relevant to supply and demand. This was the demand, very good, healthy demand, especially the last decade. And there is the supply. And for as long, we will see that for as long as there was a surplus of ships, rates were weak. And for as long as there was a shortage of ships, when I say shortage, I mean 100% utilization, because as we all understand, we cannot have over 100% utilization. This is mathematically impossible. And then you can see where we are today. The drivers of our market are changes really in demand and changes in supply. This is what it boils down to. I speak to colleagues all the time about, you know, market recovery, what impact will this have on our market, what impact the other, what event will have on our market. But it's all about the balance. It's about the game changers in demand and supply. And changes in demand really happen for a number of reasons. Political decisions can be game changers. You know, bans like the one we had in Indonesia last year, it affected badly the driver market. Boycotts, we see this in Iran and elsewhere. Wars, trade agreements or trade disagreements. This can have either a positive or negative effect. It's also the global economy. A growing, a healthy global economy is good news for our business. A slowing global economy for this reason or the other. But environmental regulations that can come into effect at any time, and they affect our business. We all remember the double hull tankers. These days, emissions controls which affect the trade demand for oil or energy, coal. Natural phenomena, of course, tsunamis, earthquakes, etc. And of course, unexpected crises like the one we had recently, Lehman Brothers, the financial crisis. But I think the takeaway point in that slide is that ship owners have no control over any of this. So demand, really for us, is a wild card. The other, of course, driver is the supply, and this is affected by scrapping, it's affected by layup, it's affected by slow steaming, which we currently have, and we'll touch on this later on in the presentation, and of course the new orders, the new deliveries, And of course, the new orders depend on a number of factors. The future prospects of how ship owners are looking at the future, positively or negatively. New building prices, the better they are, the lower they are, the more they're ordering. Of course, access to finance, interest rates, and technological improvements in new designs like the ones we had recently, which were also, partly to blame, I will only say partly to blame, for the last ordering spree that we will refer to again in the future. And all these things is within our control. Ship owners can control only the supply. And it is it is really impressive how badly we have been doing this. What do I understand by the shipping cycle? I mean, the shipping cycle, of course, has to be circular. So we have the cycle, and the upper part is what we call the upside, the strong market, and the lower part is the weak market. And really, irrespective of the drivers, irrespective of the explanations, the high point of the cycle is when we have a shortage of ships for a number of reasons. And what happens whenever we have a shortage of ships and enjoy good rates? We stop scrapping, we start ordering, and possibly we started ordering before the high. We still don't know the demand. We have no control of the demand going forward. It may be stable, it may be better, it may be worse. And of course, we start to see deliveries of new ships depending on when the orders were placed, and largely depending on shipyard capacity. And shipyard capacity these days is much more than the world really needs. So this is not very encouraging news. And then, of course, as the surplus of ships becomes bigger, we arrive at the low part of the cycle, we all get worried, and then we start scrapping our ships, and we stop ordering, and eventually, hopefully, well, the demand continues to be unknown, and eventually, hopefully, the global fleet shrinks, and we arrive at the upper part of the cycle. This is how I perceive the cycle, and I would like to try and see whether the theory fits the practice, the recent history, what we've seen in recent history happening. So this is 1999 to 2008, the demand and the supply. Until 2000, of course, 4, the market was weak, 2003, and then there was a shortage. And not surprisingly, the BDI actually matches almost exactly the balance existing at any time between supply and demand. And this is the scrapping, you see, a lot of scrapping during the weak times, and virtually no scrapping in the good times. And the orders, here, this is not the order book, these are the actual orders that have been placed year on year. And you see it during the bad times, the low part of the cycle, very little ordering, and then as soon as the good news starts, the order book picks up, and by 2007, it reached astronomical levels. So, 2009 to 2014, which is the period we have been suffering really, we can see that in 2009 and 10, actually this was the tail of the good times. The market started to rebalance itself. And then beyond 2010, we reached the historical average, more or less. And beyond that, although demand grew by a whole 7%, the supply grew by almost 12%. So it was inevitable that the market would actually be destroyed. We were not waiting for Lehman Brothers to happen. It was inevitable. And really, and this is the scrap curve, and again, very low scrapping during the good times and a lot of scrapping during the bad times. And I would like to direct your attention in the year 2013, I will come back to that. Order book all of a sudden goes up, and scrapping goes down too, which is basically the reason why we're here, as I will say later. So where are we? Let's try and see where we are today, because this is the pertinent question. So we saw that the cycle, is actually verified more or less by the actual events that took place. Let's see where we are. 2004 and 8, we had a shortage of ships, scrapping, ordering. 2010 was the historical average. Demand was healthy during all this time, a lot of deliveries, and until 2011 we reached a low, and as soon as we reached that low, scrapping went up, ordering went down, demand again was healthy, the global fleet shrank, and in 2013, the second half of 2013, we thought that the recovery had come, which is exactly what you see here on another slide. But that's where we are today, though. We are back in the low, and it is 2014. So we did not really complete the cycle. We reversed the cycle. We were expecting that since we had reached the average in 2013, we were expecting that we would continue to go firmly into the healthy part of the cycle, but unfortunately we went back. So what happens now? These are the demand fundamentals going forward by most analysts. Weaker, still healthy demand, 4%, in excess of 4% is still healthy demand historically, although not as healthy as the last 10 years when demand was well over 6% and sometimes 7% and beyond, but still healthy levels. Scrapping is something that usually we don't pay a lot of attention and we don't understand. If we assume, what should be a healthy, a normal percentage of scrapping? If we assume that the average age of the vessel is 25 years, this means that we should have 4% of the ships scrapped every year. But this 4% refers to the fleet size that existed 25 years ago, not today. So if we take into account that today's fleet is almost 4 times bigger than the fleet we had 25 years ago, then the healthy normal level of scrapping is only 1% of the existing fleet. And you see here on the graphs how these scrapping rates have varied in accordance to the market, and it reached even at 12.1% of the then fleet, of the fleet 25 years ago, in 2012. And this, in my view, is one of the main reasons why we had a very good 2013. We had a lot of scrapping, 35 million tons in 2012. That was all-time high, in my memory anyway. And this was one of the main reasons why we had a very good 2013. But then we blew it, because in 2013, scrapping went down to only 15 million tons, 20 actually million tons, and only 15 million tons in 2014. And if we were to guess the fleet development going forward, I'm sure that the analysts that are on the panel will tell you more about it, but the way we know already what the order book is for 2015, 2016, and 17, but we have to guess the scrapping. And here, I'm assuming, I'm doing my best to provide some slides that will convince me a little bit about, the better market going forward, improve my own sentiment and yours alongside with it. So if I assume that in 2015 the same tonnage will be scrapped as it was in 2012, the situation doesn't look as bad as it can develop in 2015. And actually it starts to look encouraging from the end of 2016 and beyond. Is slow steaming in danger? Well, there's a lot of talk about slow steaming. I can share with you that when I was in the States recently, a lot of investors and and analysts for that matter were actually concerned that the ships would start going faster because of the lower price of oil. And in reality, the optimum speed that we all calculate in our ships is a function of the price of bunkers and also the time charter equivalent, what we make daily. And luckily, even at today's sort of price, say 400 tons, the optimum speed of a Supramax vessel when it earns $10,000 a day is only 9.3 knots. And currently ships are doing about 11 knots because they cannot do any less due to the fact that they will have problems with their engines. So we still have more room to go. And practically this means that the price of bunkers will have to drop to $240 per ton, or alternatively the earnings of the Supramax ship should go over $16,000 a ton in bunker prices, so that we are incentivized to go faster than 11 knots. So we shouldn't worry about, in my view, about slow steaming disappearing in the foreseeable future. Market expectations. Here I excelled in trying to create good news, some optimism. We are assuming sort of a scrapping rate of 5% for 2015 as well as 5% for 2016, something which is very difficult to accomplish because now the dry bulk fleet is a modern fleet, much more modern than it's ever been actually. And still, we do not see any convincing signs for an improved chartering rate environment. What can go better? The Indonesian bans could be lifted, Brazil could do better. Congestions. Coal controls in China, I think it is, well, most analysts will agree that this is sort of neutral for the market. Low oil prices should help the market because it reduces transportation costs and creates stronger global growth. And of course, we invest a lot of hope in the growth in India and Africa. Well, I think more people are bear than bulls in this period. It's the bear says that it's up to the ship owners to correct the market. History says that ship owners are doing a lousy job of that. But I will finish my speech by saying, expect the unexpected. Thank you.
Thank you very much, Mr. I would now like to invite Mr. Joe Dragnis, CEO of Golden Port Holdings.
Ladies and gentlemen, good evening. Thank you for the kind invitation to share some thoughts on the market and one of the current trends of our industry today, before I go into my main topic. This trend refers to the consolidation within the current challenging rate environment, and I will try to review some general points from the perspective of the capital markets. As far as the current markets are concerned, obviously we just heard an overview. I would like to very briefly discuss as well the dry bulk, but the container sector a little bit, as rates there are facing more pressure and sentiment seems to be pessimistic, at least for now. So, dry bulk freight rates during the third quarter of 2014 were weaker than the first half of the year, as demand lagged net fleet growth. Market expectations for China to meaningfully reduce domestic iron ore production in favor of imports proved to be overly optimistic. As was mentioned, coal imports to China have been affected by adverse policies there, and the Indonesian nickel export ban remains in place. In this environment, Supramax rates were once again more resilient than Capesize and Panamax rates, reflecting their versatility and reduced earning volatility, while container ship rates remained broadly stable, but unfortunately at levels close to all-time lows. The outlook for 2015 is uncertain, and the long-awaited recovery in the dry bulk sector may not materialize in the near term, as the order book casts a shadow over demand. This is reflected in the Capesize and the Supramax FFA, freight forward agreements for CAL 15, which are currently trading at $12,500 for the Capesize and for $8,900 per day for the Supramax as of closing yesterday. As far as ship prices are concerned, there is a belief that very soon we may be at levels experienced back in 2012, which were close to 7-year lows. The outlook for the container ship sector is relatively more stable, but still remains quite subdued. The recovery there mainly depends on geopolitical uncertainties receding and global economic growth picking up. At the same time, tonnage providers are being squeezed by liner companies that have formed themselves into alliances and are trying to increase profitability and efficiency themselves. However, on a more positive note, there is one rule for every investor. Market challenges, of course, always present opportunities. Even more positive point is that today these opportunities come in the form of well-priced second-hand tonnage that are currently predominantly better priced than investing in new buildings. So that means that new investors will not add to the existing oversupply of each subsector. However, prospective buyers need to have their balance sheet capacity, need to have adequate balance sheet capacity, so that they can afford to be patient until there is a market improvement. The dry bulk market has more potential buyers today compared to container ships, and they are mainly chasing second-hand Japanese tonnage. An even greater opportunity, some may say, may be present in the form of acquiring second-hand quality Chinese, yes, I dare say, or South Korean tonnage that are priced on a significant discount to their Japanese counterparts. Such an acquisition decision should be focused on tonnage built from very high quality yards, and attention should be paid on the vendor maker list of these vessels. As far as the containers are concerned, there is a similar investment opportunity. It's a little bit more tricky. The technical condition of the ship need to be carefully assessed, as well as the technical specifications. Vessels with reasonable speed consumption characteristics, as well as high reefer capacity, and this is key in the gear sector, and especially in the smaller to medium-sized container segments, are more likely to command considerably higher charter rates and secure higher employment utilization. Now, turning to my main topic, which is how this current market is affecting consolidation, and also with respect to the capital markets as well. Well, our industry is generally considered as being quite highly fragmented, with relatively low barriers to entry, especially in some sectors. The past decade is characterized by periods of easy access to capital, provided mainly in the form of traditional asset-backed debt and other types of securities, such as public and private equity, bonds, and other instruments available through the capital markets. More specifically, the Hellenic fleet controls today about 4,700 vessels, which account for more than 50.5% of the global total. This fleet has grown significantly in the last few years, and is managed today by 668 about distinct shipping groups. Comparing this number with 2011, which signals the beginning of a more challenging period in shipping, this represents a drop of 12%. So today, fewer companies control more ships. Another interesting statistic is that in terms of deadweight, the largest 30 groups in our country control 56% of the fleet, and the top 70 control 76% of the fleet, according to Petroleum Research. Now, looking more globally, the liner, tanker, shipbrokers, and gas transportation industries are leading the change. The largest 10 liner corporations control 64% of the market. However, I believe that should the dry bulk market continue to deteriorate, the stretched balance sheets will lead to more consolidation. So what are the factors driving consolidation today, especially within the challenging markets? Shipping is a capital-intensive business. Equity capital markets generally facilitate mergers by providing a currency to listed companies. There are relatively few large-scale precedents in the shipping sector, as there is limited scope for vertical consolidation. Investors prefer pure play companies, especially in the US. This means that alliances in the shipping industry are typically between two companies in the same subsector. So, most deals in 2014 have been seeking to consolidate ownership and streamline corporate structures, such as the case of Star Bulk, Ocean Bulk, and Excel Maritime, and similar case of Knightsbridge tankers with Golden Ocean, rather than non-affiliated entities, as we saw by the failed merger, attempted merger of Avance Gas with Dorian LPG. In the past, there have been several more traditional M&A deals, like the merger of Excel Maritime and Quintana Shipping in 2008, and the competitive sale process that led to an acquisition and carve-up of the assets of OMI between TK and TORM in 2007. So, in the good markets, it's more likely to see consolidation that is led by the willingness to grow, and today we're seeing consolidation more by the willingness to streamline the corporate structures and proceed with cost cutting. So, capital market access is another key point, especially today. Investors look for high market capitalization and liquidity, and therefore, relatively larger publicly quoted corporations tend to enjoy better net asset value metrics. Of course, today, with this challenging market, that's out of the window, but that is the general rule. The need to achieve critical mass ahead of going public has also fostered recently mergers between privately held companies. One example is Hafnia Tankers and Diamond S. So these two companies combine the interests of several independent financial sponsors in the product tanker subsector. This trend is likely to be replicated in other sectors like dry bulk carriers. Next point refers to regulatory requirements and has to do with debt, and especially Basel III, and the increased funding costs has led major lenders to lower LTV, loan-to-value ratios of the shipping loans and favor larger shipping corporations. Another point has to do with forced asset sales, and okay, it goes without saying that a company with a high-quality balance sheet is more likely to secure the high-quality tonnage. But of course, it doesn't mean always bigger has a stronger balance sheet. That's not always the rule. The final point here has to do with economies of scale in ship management. Now, this is a vast subject and has been studied by many with relatively inconclusive results. Increased costs to correspond to new regulations in the shipping business is driving the owner's decision to scale up. Undoubtedly, larger companies obtain higher discounts, enjoy greater in-house knowledge, and are more keenly chased by suppliers and potentially by charters. That's especially true in the container, secondly the gas, and then maybe the tanker sector. Maybe a little bit less in the dry bulk segments. However, these benefits are often outweighed by smaller, leaner, and more flexible management structures which can correspond and effectively correspond to the challenging environment. There is a definite diminishing rate of economies of scale in ship management after a certain number of vessels in the fleet. At least that is my view. So, challenges. Now, this is a little bit of a wishful thinking, but management teams who try to see the bigger picture for our industry by aiming to achieve sustainable returns need to focus on consolidating parts of the existing fleets in each sector accordingly. Growth through continuous new building orders in a massively oversupplied market makes our jobs much more challenging. The liner industry is a painful reminder of a consolidated market, actually a very consolidated market, that in the hunt for market share among the few existing companies led to devastating results for their shareholders. And as we know, only very recently did the leaders start to show again positive quarters like Maersk, for example, or CMA CGM, etc. Another point has to do with hedge funds and the private equity-driven deals. Recently, of course, they have grabbed the headlines. However, due to their model, these guys will be looking for an exit on the back of a market recovery. Now, as investors lose patience and as this market is delayed to improve, What will happen if some of these people want to get out before the market has had a chance to recover? That is a question to consider. Before I close concluding, the key reason for limited consolidation between non-affiliated entities today and before is the desire for the sponsors to retain control of their companies, even if they hold a small equity stake, by structuring poison pills like dual share structures, etc. This drives at the heart of the conflict between existing sponsors, managers, and institutional shareholders who always favor, of course, transparency and simplicity in corporate structures. So in concluding, consolidation, especially today, changes many things about the company and the environment in which it operates. However, some things remain unchanged. No matter how much of a competitive advantage can be obtained by size, that is by economies of scale, astute timing of acquisitions and disposals, and hands-on efficient management remain the only absolute key to success and the only key to survival. Thank you very much.
Thank you very much, Mr. Frankis. I would now like to invite Mr. George Vodomichalis, Managing Director of Phoenix Shipping and Trading.
Thank you, Mr. Chairman. Good evening, ladies and gentlemen. Natalia, thank you for inviting us. Congratulations again on your 10th anniversary. Can we stop the video, please? Thank you. Give me a minute. No presentations, no PowerPoint presentations here. When Natalia called me and said, would you participate in the ICS forum, I said, sure, what do you want to talk about? She said, that sinking feeling. I said, you're talking to the wrong person. I am an eternal optimist. It is a matter of conviction for me. Otherwise, I could not survive in this business. But it got me to thinking, and the only thing that kind of ran again and again and again in my mind is this old advertising for a language program. Can you put the video on, please? From the beginning, if possible. Thank you. Is the voice?
Yeah.
Hello? This is the German Coast Guard. What are you thinking about?
Now, to go back to the earlier question about are we going to have a president next week in the Parliament, the German Coast Guard had something to do with this. Joking aside, are we sinking? Are we thinking about it? I really don't know. There are a number of very large problems the industry is facing. Not in any order of importance, but obviously oversupply, the lack of demand, world GDP, which is basically stagnating, all the growth that was coming from the Far East and Southeast Asia, and even the Arabian Gulf and the possibilities of India and Africa not going anywhere. The fact that regulatory environment has become more and more difficult. The interesting thing is that we hear about the ICS and all the great work it does, and it does do a good job, and we have a lot of good practitioners. And then this morning, one of my brokers was actually in the audience today. I have the vessel coming open on the North Continent right before Christmas, and the market is, let's say, at 10,000, roughly. So as a piece of business, I told him, okay, what are these guys paying? He says they're paying 6,000. I said, okay, why? He said, well, because you're going to be loading in a port where bunkers are very cheap, and you can fill her up in bunkers and make her a supply station later on. I said, what are these guys thinking? This is the other problem. What are these guys thinking? They're thinking us into sinking. These people are out there and they don't know what they're doing. This is a constant problem we have. We have it every day in operations. Mr. Dragos talked about consolidation. Yes, we need to consolidate. We need to have professionals. We need to have real offices. Management is becoming much more expensive. For those of us, and long before me for sure, who have been managing ships out of Greece, we've always had professional people, but we've done it cheaply and efficiently. We cannot do this anymore. It's not cheap anymore. It might be efficient, but it's not cheap anymore. Mr. Gougouro and Michalis talked about cycles. We've all played a cycle. Yes, and we do expect the unexpected, or we hope for it anyway. And we also know that 80% of the time we lose money, but we stay in the business about 20% of the time that we make too much money. And that's the problem. We don't know how to manage that. We know how to manage risk. We learn how to manage risk. It becomes part of our genera, but we don't know how to manage good markets. Michael is right. We are notoriously poor at it. We go out there and we build vessels. We order more. Yes, we have a much younger fleet, a much better fleet, technologically advanced, or is it? I'm not quite sure. Mr. Zanis alluded to private equity institutional investors, both in public and in private companies. They will be looking for an exit. Then on the other hand, they've been investing in much more complicated businesses than ours for a long time, and they still invest in them. So obviously they're smart people. I hope they are anyway, and I hope they don't pull the plug too fast. All in all, because I don't want to tire you and I'd like to have a conversation afterwards, all in all, I don't think we're sinking. But I do think that we should be thinking. We should be thinking about how to manage our vessels better. We should be thinking about the problems we have, the lack of demand in the world. We should be thinking about the fact that we can't find crews which are qualified, especially for the new ships we're building, which are technologically advanced. You take delivery of a ship today. For those of you who have been on a vessel built over the past 12 or 18 or 24 months, if you've been on a bridge, do you remember the arcades when we used to go when we were in college and play electronic games? This is what it looks like. It's amazing. Maps are electronic. It's all downloaded. They download the maps, so they don't know anything in the office. They download the right maps. They pass in the passer's plans. You've got to have a dummy in the office to follow what they're doing on board. And all sorts of other things. All the alarms are on LED displays. You tell me which crews in totality are ready for this. Very few. So these are problems we really have to deal with. So I would say we're not sinking. Let's not sink, but let's think about how we can make things a bit better. Thank you.
Thank you very much, Mr. Michalis, for that not sinking feeling. I would now like to invite, please, Mr. Harold Malone, Managing Director of Jefferies Maritime Investments Banking Group. Thank you.
I think this is the second time I've had to call you, George, and it's always a challenge. But thank you, Mr. Chairman, and to this esteemed body. I really appreciate the opportunity to be with all of you here tonight. I perhaps should have titled my presentation "Shipping's Rise in the Capital Markets," because it has been a tremendous rise, as some of the panelists have already alluded to, as well as a couple of the topics that I'm going to touch upon this evening. The topic I want to talk about is really some of the key themes in capital markets, and I think has been touched upon by several of the other, the other panelists. And then hopefully leave some more questions that I think will be good for discussion later. I think a lot of people in the shipping community have historically asked why does capital markets matter to them, and I think today it's increasingly clear that if this is an industry you're going to be participating in, that this is something that you need to have some level of familiarity and some level of comfort with, because you're going to be competing with competitors that are either in the public markets or have public market capital behind them, and that's going to drive how they behave and the decisions that they make. So, in terms of the things I want to cover this evening, first of all, I think it's important to see where the industry's gone over the last 10 to 15 years in the markets. Second, as several of the others have talked about, there's been a huge rise, and I think there will be ultimately more of an impact of, in particular, private institutional capital in the market. And then finally, while the market's risen, what is it going to take to reopen activity in the capital markets, particularly for people backed by private capital looking for exits? Going back really to about the point I began my career in the sector, which was a little over 10 years ago, if you looked at the landscape, it was really quite concentrated. There was a limited universe of companies. They were essentially all in one sector in the U.S., the tanker industry, although you'd see about the same trend in Europe. There were a couple of very established players, OSG, TK, OMI, frontline names that people have touched on here. A couple of financing vehicles, Nordic American and Knightsbridge, which were vehicles for BP and Shell, and the first in the wave of IPOs, Stelmar, Genmar, Chacos, and really all growth-oriented stocks. Where has the market come since that point? If you look today in the U.S., we now have over 40 public listed companies. It's across a wide range of sectors. Tankers are still important, but you now have dry and container, and really over the last 18 to 24 months, the rise of gas in the United States. Not only now do you have continued growth investments, but you've also seen a significant rise of what we would call a yield-oriented investment, and most notably of those have been the rise of the MLPs. A couple of questions and notes to make. One of the things that's interesting about this slide is if you go back to the previous slide, about half of the logos that are in that box are not with us anymore. They've either fallen on difficult times like OSG or General Maritime. They've been acquired like Stelmar and OMI, or they have moved into a different box like Knightsbridge, which was the tanker company, has now become a dry bulk company. So one of the things to think about from the capital markets in the industry is that it's always changing and evolving. So, you know, what will this industry look like in the capital markets in 10 to 15 years? One of the other things to think about is what have these companies been doing in the capital markets? And if you go back to their earlier period that I touched upon, they were really only using 3 products, that being common equity, predominantly ship mortgage bank debt, and the occasional high-yield issuer. Today, shipping is, as someone pointed out, a hugely capital-intensive industry, and I would say among the most aggressive and creative at accessing all forms of available capital. So in addition to the 3 that you saw 10 to 15 years ago, you're seeing a complete menu of various forms of capital that are available to companies that have access to the public markets. Starting with convertible debt, going through a whole series of yield instruments from high-yield debt, baby bonds, preferreds, and then up to MLPs and common equity. And so I think something else that the industry and the capital markets can think about is what's going to happen to these companies and these products as we face what's going to ultimately be a rising yield environment, which I think is something that's perhaps not factored into people's thinking about the industry and going forward from today. This is a topic that I think a number of people have touched upon already, and that's the rise of institutional capital in shipping. And in this slide, we highlight the private institutional capital in shipping. And one of the things that I think I want to spend a little time on is people use the term private equity, which is a very broadly used term, and I think John put it quite well in highlighting differences between hedge funds and private equity. And there are various flavors of capital that have come into the market, and they come into it in different ways, and how they behave, how they exit, and how they think about the world is very different. And so it's important if you're in the market to understand how a opportunistic fund who's acquired an asset via buying a purchase of a portfolio of loans from a bank is going to behave as opposed to a traditional private equity fund who are characterized by making control investments, have a very long time horizon, and generally are investing in corporate level transactions as opposed to asset level transactions. You do see traditional private equity firms on this list, names like Carlyle, First Reserve, Oak Hill, but more predominantly from a capital markets perspective, the institutional capital that's come in has not been traditional private equity. It's been hedge fund money, it's been distressed money, and where it's been the large global firms, it has been the opportunity arms of this fund. So Oaktree, it's been the distressed arm, has been the opportunities fund. It's not been the traditional private equity fund. And so what's different about this capital that's important in the industry? First of all, a lot of it has a much shorter time horizon. So as opposed to traditional private equity that talks about a 5 to 7 year time horizon, you have a lot of money that has shorter time horizons. You have money that thinks about investing more from a trade, that they're making a trade as opposed to building businesses and building companies. And you have a lot of money that I think is coming to the sector as a result of the actions taken by central banks all over the world to flood liquidity in the market that has been looking for a home. And one of the things that's appealed to that capital with shipping is it's a place you can put a lot of money to work very easily, particularly through ordering new buildings, and that's going to have a lasting effect, I think, on the industry for many years to come. Finally, the last question I wanted to touch briefly upon is, when are you going to see a correlation of activity in the markets? The markets in the U.S. tend to think about things on an operating earnings basis, so they're typically looking at cash flow, and they're typically thinking about that over a relatively short time horizon. So last 12 months, next 6 to maybe, if you're lucky, 24 months. And so what you see across all of the sectors is a strong correlation of issuance activity to when you see strong rates. What I've shown here is tanker rates and tanker activity over the last 2 years to the beginning of, I guess that's almost 3 years now, beginning of 2012. And so what you see is when you've seen periods of rising rates, you've seen people accessing the market. That trend holds up also very well in the dry bulk sector. If you look, you see perhaps an even stronger correlation. So typically the answer to the question is, when are the markets going to be open? It's going to be when you see rates. I think you've seen the rise of gas really be just another demonstration of that fundamental point. And so we certainly think things are primed, particularly on the tanker sector, given the rates you're seeing, to see renewed activity from the markets as we get into the new year. We think that may be supported by consolidation among a number of the private capital players that we saw on the prior page as they seek to achieve economies of scale and some of the things that the markets are looking for. But in general, I think while people may have a sinking feeling that when you think about shipping in the capital markets, it's been on a rising trend, and we think that's something that's going to continue going forward.
Thank you very much, Mr. Malone. I would now like to invite Mr. Henry Kura, Global Head of Research, Bremer ACM, Shipbroking London.
Thank you. Good evening, ladies and gentlemen. I think Simon and I are the sole representatives on the panel from the shipbroking community, and I think we are formally the drivers of consolidation in this industry at the moment. I think there's more consolidation going on in shipbroking than anywhere else in the industry. I am originally ACM and Braemar merged in July this year. So we're supporting the trend. This short presentation this evening, I'm going to focus on one of the few markets that is showing some life at the moment, the tanker sector. And I'm going to focus on a very specific element of the tanker sector, which is the change in oil price. It's obviously the talk at the moment, the very dramatic fall in oil price that we've seen. Here's our chart of Brent and WTI, just to give you two of the key benchmark oil prices. I've said this is no ordinary oil price, but it isn't. The reason the oil price is falling at the moment, and falling so fast, I think we're down to about $66 a barrel today for Brent, is because we've had a very fundamental shift in the way the oil markets work. And essentially OPEC, namely Saudi, has either found itself unable, or more importantly unwilling, to support the oil price. And so we've seen that floor removed from oil prices. We've seen the floor removed from oil prices, and this has affected not just the short term, obviously you've seen this dramatic decline, but also the longer term view. This isn't a blip from what most analysts are telling us. Morgan Stanley came out a couple of days ago suggesting that 2015 would come at about $70 a barrel, 2016 maybe $88 a barrel, could drop as low as $43 a barrel in Q2 next year. Kuwait's working on an assumption it's going to go up $65 a barrel next year. This is a very different oil market environment we're facing going forward. Who knows? Okay, but this is what popular opinion suggests. We're facing a very different environment now. One of the things that's interesting about this particular fall in oil price, and here I'm showing the oil price in blue again, is what is the driver behind it? So here, the problem is essentially oversupply. And that's unlike previous oil price slumps, particularly in January, when we saw a very precipitous fall in oil prices that was obviously driven by the financial crisis and a big drop in demand. And there, obviously, the petrol pump, demand disappeared, oil prices remained steady, so refining margins collapsed, and so refiners stopped producing oil, and obviously reduced demand for tankers generally. And that happened again in sort of 2012 when we saw that price hit. It was a demand-driven price fall. What we're seeing now is a supply-driven price fall. So we're seeing obviously US shale oil, Canadian tar sands, you name it, a lot of extra oil in the market that's depressed the oil price, and actually the petrol pump demand wasn't doing too badly. So what we found is a lot of refiners have had wonderful margins, particularly in Europe and Asia, and so they've increased their refining throughputs, and that's been one of the drivers of increased tanker demand over the past few months, and why we're seeing reasonably strong rates across the board, not just the crude sector, but also the product sector, which seemed very weak up until this point. So that's quite an encouraging trend. Obviously, in the immediate term, every ship owner is going to be feeling this on his bottom line. Say on the tanker side, we've got an improved earning environment. Typically happens this time of year anyway, with Q4, coming on bad weather conditions. But here, if you look at this red line on this graph showing the earnings relative to the world scale, of course, those earnings really are picking up off the back of the lower bunker price. But what I really want to focus on in this presentation is what it means from here. And I've just given a few questions. I'm not going to go over all of these in this auditorium. I'll just focus on a few. But I just want to raise these as issues, because I think it's very important that we start thinking about this in the tanker market. One of the key questions is whether we see a return of floating storage. This oil market's come off very fast. A contango structure has developed in the forward oil market. It's a small contango relative to where it was in 2008, 2009. But it is a contango. People are starting to think about whether we're going to create demand for tankers via floating storage, anything like we did in 2008, 2009. A lot of people suggest this is a bullish factor. It probably isn't. It's a way of coping with a weak market rather than a way of supporting freight levels. But I'll talk a little bit about that in the next couple of slides. The other key question is, what does it mean for high-cost oil production? And there we're looking at, most non-conventional oil is high-cost relative to Saudi and Kuwait and so on. But specifically, the key growth areas for oil have been tar sands, have been shale oil, which have a much higher break-even cost than your average Middle Eastern production. And so now this oil price is coming down, possibly as a strategy adopted by Saudi to try and squeeze some of these higher oil cost producers in order, obviously, to maintain its market share going forwards. But we're seeing now, particularly at $66 a barrel, and that's Brent, WTI probably even less, that's starting to squeeze some of that production in the US. So what we're asking ourselves, well, what does this mean for our arguments as to where trade flows are going to develop? What does it mean in terms of vessel efficiency? What does it mean in terms of voyage length? All these parameters were very fundamental to our view of the tanker market going forward. And this is changing everything very fast, so we need to focus on it. What does it mean for refining economics and CPP trades? One of the interesting features of today's oil price slump is that actually refining margins in the US aren't doing so well relatively. They're still great margins, but they've come off a little bit because, of course, relatively their oil price relative to Brent has increased. And so what we're seeing is their competitive advantage is starting to deteriorate. And of course, when you think about where the US has come from in the last 3 years as a refined product producer, that could be a game changer as well. They're flooding European markets with refined products, flooding Latin America with refined products. Now, if they lose their competitive edge, that could change. We touched on earlier, I forget who mentioned it, eco ships. Longer term, I mean, whether you believe in eco ships or certainly believe the numbers people are putting forward to eco ships, there's no doubt that as the bunker price comes down, the advantage of the eco proposition is slightly smaller, and there'll be some grumblings, I imagine, from some investors who put their money behind these eco ships. But if we're now talking about $70 a barrel and the relative bunker price, that's not such a strength now to put your money into those new buildings. And then further afield, a low oil price environment has some very macro implications as well. So, for instance, what does it mean for civil unrest in countries that have very high break-even levels? They need a high oil price, like Venezuela, like Nigeria, like Russia. What happens when that carpet is pulled from under their feet and they can no longer balance their budgets? What happens in terms of civil unrest, in terms of strikes, in terms of wars potentially? All these could have implications for the market. I mentioned here a low oil price environment can also change the landscape of cargo interests. And we saw in the late 1990s a massive change in the oil, among the oil majors, of course, very, very substantial consolidation. Interesting to hear rumours, I have no idea how substantiated, that Shell was sniffing around BP again a couple of days ago. But this is the sort of thing that happens in a low oil price environment. And so we could suddenly see the players that make up our market changing quite dramatically. And then finally, a lower oil price obviously has an impact on GDP, and that affects all of us in that room, every sector of this market. It varies, depending on who you ask, what impact low oil price has on GDP growth, but it does have a positive impact. And it also, from our side, the tanker side, tends to slow the shift away from oil. So there's a lot of energy substitution that's taking place during a high oil price environment that probably will look a little less appealing in a low oil price environment. Finally, obviously what we're all trying to work out is what does it all mean? Is it net positive for us? Is it net bearish for us? And that's, I'll try and conclude with a little thought on that. I'm just going to touch on the ones I'm showing in red here going forward. The floating storage, high cost oil production, and a little bit on the implications for oil producers and low oil prices. Floating storage, 2009, 2011, was a pretty big part of this tanker market. We saw about 150 million barrels put into floating storage. It was about 100 million barrels between Jan and May of crude alone. Obviously, a very dramatic fall in oil price caused that. Diesel as well goes into storage. It produced a very, very substantial demand for ships, and of course that was absolutely necessary at the time because you saw an awful lot of ships coming off the new building yards, and that was enabled our market on the tanker side to sustain a very, very big drop in demand without having to lay vessels up. So the question is, could we see something like that again? Now it's interesting, on the oil side, the numbers that are being bounced around at the moment suggest that in 2008-2009 there was probably an oversupply of about 230 million barrels of oil. That created 100 million barrels of storage. Today, or at least over the next 6 months, they're talking about 300 million barrels of oversupply hitting the oil market because it takes a while for US oil production to slow down. And so inevitably people are starting to say, well, what does that mean for storage? Are we going to see a big growth in the storage? If you look at the forward price structure of oil, it doesn't suggest there's much demand for storage there yet. I mean, in 2008, 2009, we went down to a $3 per barrel differential between the front month and the second month, and that was obviously what drove a lot of that storage demand. We're down to about $1 now. So one could argue that no, there's no contango there to support floating storage. But in essence, what's happening is there's a lot more shore-based storage available at the moment. Cushing is emptied out. There's a lot of shore storage in Cushing. There's a lot more storage available in Northwest Europe. There's no gasoline blending going on to speak of, so there's a lot of spare capacity there. So So what's happening now is the shore storage is starting to fill up, and that's got some way to go. It's not until shore storage fills up that then you start looking at floating storage, and only then, if the market is relatively weak. You're not going to be paying $45,000 a day, $50,000 a day for floating storage on the VLCC. So although it's eminently possible that we'll see floating storage, I don't see this as a massive component in this next year or two, and I don't think it's a particularly bullish component for freight. So the next issue is US oil production. Of course, this is one of the key areas we're trying to work out. At what price do you start shutting in US shale oil production? There were some numbers quoted recently that said at about $70 a barrel, you shut in about 150,000 barrels a day of the most expensive shale oil. But the three biggest shale oil producing areas, Bakken, Eagle Ford, and the Permian Basin, they're about 2/3 of all the drill rigs in the US. There's no sign of any change there. Now, they have a much lower break-even generally. They're probably looking at about 100,000 barrels a day growth in January even. So we're not saying it's not going to happen, but we're saying it's going to take a while to happen because a lot of these fields, they've got some cost. They've got fixed power on their rigs. They're going to produce oil whatever happens. What's affected, of course, is future investment. There we are seeing a change. And so, we're looking at about, let's say we were expecting 1 million barrels a day growth out of the US, this year. 4 months ago, we're probably looking at about 600, 750. And this is how we model it. So that green area we're looking at there is our forecast for crude oil production. We've shaped off a little bit of that forecast. Then obviously if we want to work out, well, what are they going to take in from Canada? That's the light blue area. And what's left to be imported? And there you can see, even in the last four years, we've gone from 7.7 million barrels a day imports to about 4.5 million barrels a day. A big, big reduction. And that reduction continues irrespective of the lower oil price and perhaps a little bit off the US oil production. What does that mean for those people that were exporting to the US? Well, for Canada it doesn't make much difference. Canada carries on exporting to the US quite happily. West Africa has almost lost all its exports to the US. That's the green area at the top of the chart. And going forward, there's not a lot more you can lose. It's Latin America and Middle East that are the next ones probably to suffer. And that becomes quite interesting for the tanker market. Because there you're stopping moving VLCCs effectively laden into the Atlantic Basin with Middle Eastern crude. At the same time, you've got a big jump of Atlantic Basin crude wanting to find a home in Asia, because no one in the Atlantic Basin wants it. And that creates two things. One, a big ton-mile growth for the bigger ships anyway, because it's a much longer voyage for a big Middle East to China, say, than West Africa to China. West Africa China's a longer voyage, obviously. Or Caribbean China's a longer voyage than Middle East China. But it also increases the inefficiency of the fleet. It won't be long now before we see regular ballasting of VLCCs between, obviously, West Africa carriers we see already, West Africa, China we see already, but also carriers China. I wouldn't be surprised if you see that as a regular VLCC round voyage. And that does give an impetus to demand. And there's how we model it, for instance, that's as a percentage share of all imports going forward for China and for India. You can see a reduction in percentage terms of Middle Eastern crude going to these two countries. In absolute terms, it's still an increase as it happens. But obviously the big gainers become South and Central America and West Africa, pushing more and more crude into Asia. It's come off a little bit, obviously, with our forecasts changing because of the oil price. So that blue line is our new demand line for China and India in terms of deadweight required. But it's still safe to say that China and India, so China is the green line here at the top, and India is the red line a little bit further down. Those are the two most important drivers of crude tanker demand, and those, despite what you hear about slowdown of Chinese economic growth and transformation into a more consumer-driven economy, it's still very, very key to the growth forecast that we're pushing into this market. And here, just showing you how that works out in terms of crude demand going forwards. And you can see, between 2014-15, relatively flat growth, but a jump of 1% in 2016 and 2% in 2017. But what's interesting here, of course, is if you look at the intra-west, which is the orange bar at the top, you look at the forecast there, we're seeing a reduction. And if you see west to east, we see a big growth over that period. and east to west, a big decline over that period. And this is why I'm saying, in absolute terms, that within a year will translate into a much bigger flow from west to east than from east to west. And you can see that trend over the past few years. That's what we expect to continue, and that's where the inefficiency starts coming in, which is a bullish factor for the crude market. Now, it needs to be, because crude fleet is growing too. I'm just showing the VLCC fleet here. Our forecast is the black line. The one top left shows you the overall fleet, so taking the 20-year phase out, which is the recent historical average. We expect to see, about 10 ship growth in 2014-15, and then a bit of a jump in 2016. That's moderate compared to what we've seen in the past. That's tolerable. But interestingly, when you look at that graph on the bottom right, that shows you the change in the 15-year-old fleet. And of course, when you talk about Atlantic Basin, it is age restricted to a certain extent. The 15-year-old fleet, because a lot of these vessels are starting to hit that 14, 15-year bracket, that suggests to us that 15-year fleet really doesn't change at all. So we've got demand growth and very little change over the next year, certainly 2015 in the fleet size, and only 2016 we start seeing that grow at all. Suezmax fleet is offering no competition. Suezmax fleet is actually declining between 2014 and 15, we expect. Again, 2016 jumps a little bit. So all these suggest to us a relatively positive short-term environment. I'm not saying anything here for 2016 onwards. We've still got slots for 2016 onwards. We could spoil this overnight. But for the time being, we reckon that this market is not going to recover dramatically. We're not back to 2004, not back to 2007. But we do have the foundations for certainly a lot more volatility coming back into this sector. Now, I said I'd conclude just a little bit of a long-term macro view about talking about the oil price, the break-even required by a lot of these oil producers. So Libya, this was published by the IMF recently, Libya apparently needs $184 a barrel to balance its books. And if it doesn't balance its books, it borrows off Russia. Oh, no, you can't do that anymore, because Russia doesn't have any money either. So this could be a real problem. Iran needs $131 a barrel to break even. It's not going to get that. So there could be a lot of conflict there. Nigeria had a war chest of about $80 billion in 2008 that it built up thanks to the strong oil prices. That's now down to around $4 billion. So it's going to run out of money fairly soon as well if those oil prices are sustained. And it's only really, further down that you see, a more tolerable, $70 a barrel. Saudi could probably survive $70 a barrel. It's got a huge war chest purposely for that. So Saudi's probably going to try and do a little squeeze here. It can last a lot longer than everybody else. But what's that going to do for these other countries? What's that going to do for social unrest within Venezuela, within Nigeria, within Russia? Russia's crude exports, relatively cheap to produce, but it's got to push them through a vast pipeline to Asia. That's massively expensive. So there, the break-even cost is a lot higher. And I show this as the last graph, just following on from that. If you look at the VLCC rates over the past 14 years, say, in this example, a lot of volatility, obviously, we saw 2003, 2008. If you look at some of those spikes, so, PDVSA workers' strike, Venezuela in 2003, that was one of the big jumps that was created in the market. Nigerian workers' strike in May 2008, that caused another big jump in the market. So you can see where I'm getting at. This sort of destabilized environment, this new geopolitical risk that we see, could have very important implications for tanker markets going forward. So, by and large, the combination of larger ton-mile growth, increased inefficiency of the crude tanker fleet, we're reasonably optimistic about this market going forward over the next couple of years. Thank you.
Any longer. They shut the office here, and I went back to London to help start Partner Shipping Services. But, so much that I love being back in London and working in the London broking style, that within 6 months I had resigned, and by the end of last year I'd entered into a partnership back here in Greece with my friends in person. Now the problem with working for others is that not only do you have to do as you're told, you have to think as you're told. This is my third contribution, thank you Daria, to this forum, firstly with HSBC. Now, with HSBC, there's corporate responsibility, which led me to toe the party line. I did give, I think, an honest and balanced, but a somewhat limiting view of the market. Heartland was a different story. I had to pitch the view that would best increase the bottom line with, should we say, questionable sales techniques. Now, I have freedom to express what I really think. But this is freedom to create and construct, to wonder and to venture, and such freedom requires that the individual be active and responsible, not a slave or a well-fed cog in the machine. Now, I'm no longer a slave to the machine, well-fed or otherwise, and I feel I have a duty to say what I really think about the market, point out where I see the hazards and the opportunities, and leave it to you, clients, friends, students, whoever, to make your own minds up. This is nothing more than my opinion, but it's based on facts, and I'm afraid to say that it is not bullish or even optimistic. But then the Niazi. I was one of the lone voices amongst my brother and sister brokers this time last year, not saying that the market would be great in 2014 and 2015. I wish I'd been more confident in expressing my opinion more vocally. It may have had some effect, but most probably not. Brokers can rarely take the credit when things go right, and mostly take the blame when they go wrong. This approach will not make me the most successful broker in the world, but at least I will be able to sleep at night knowing that I have spoken my mind. So Henry, I'm afraid, there's no consolidation going on here anytime soon. So what will I talk about? Well, Pride Bulk S&P, in particular where we are now, what the future may look like, and causes for hope. Now this is an interesting graph, which I want to bring to your attention. It looks like lots of the graphs that we've seen already tonight, but it actually comes from an academic, a guy called Jean-Paul Rodrigue, a Canadian transport geographer, a man after my own heart, showing the different stages of a price rise cycle. I'm sure many of us will recognise the various phases and stages shown. I want to use the model to see where we are on this wave and see how it connects with the other important factors in the S&P market, as Mihalis has said, good old-fashioned supply and demand. So let's look at prices. What have we done over the last 30 years? Are they comparatively cheap now? And where are we on the curve? Are we enthusiastic? Fear? Desperation? Well, this is all the bulk carrier prices. I'm concentrating on prices. I've let my friends, the owners, suffer with charter rates. This is prices. And this gives a pretty similar picture already to what we've been looking at with the various charter rates over that period. It shows 5-year-old prices for all the 4 major factors. Obviously, what most strikes out at us again is the big jump between 2006 and 2008, where the market really moved. And these were, indeed, for us as S&P brokers, very exciting days. But we can see a few other bumps in there. 2003, 2005, 2009, 2011, and 2013 to 14. We seem to be gradually drifting around to normal. But if we stretch it out to 40 years, how do prices look then? Well, I've just concentrated here on Handys and Panamaxes, but it makes the last 10 years look even more volatile. And sadly, some further space to fall. So, in effect, in the last 15 years, there's been 4 mini booms. 2003 to 2005, which ended with the first Chinese calling off period of growth with raw material imports. Then supply and demand caught up with each other again, 2006, only to be dropped catastrophically low by the financial crisis of September 2008. 2009 to 11 was driven mainly by the stimulus package injected by the Chinese into their economy until supply caught up again. And then 2013 and 14, driven by what exactly? increasing charter rates, certainly, driven in turn by increasing iron ore shipments at the time. But then prices continued to rise, on the hope that 2013 reflected a bottom out of prices and a new cycle had begun. But freight rates did not continue to rise, and this boom was brought to an end. All this, from 2003 to 2014, has been driven and underwritten by the commodity supercycle, in turn driven by China's extraordinary growth. But this is petering out now. The last two mini booms have both been at lower peaks than the preceding one. So, where are we historically? Are we heading into cheap territory? Well, if we look at the last 40 years, we see that the Panamax price now is below the historical average by 10%. So cheaper. And handies, as you can see, not quite there yet. That graph there shows the historical average, and you can see that we're approaching that historical average. The prices really fall below the historical average on this graph because 2016, 2006 or 2008 was so huge a bubble. But if you take 2006 to 2008 out, the picture is different. 20 million. Today, the 5-year-old Panamax historical average is 18.75. And again, you look at the 12.75, we've still got a long way to go down. That said, however, last couple of days reported 2014 Japanese-built handy has just been sold at 18 million. So we're going in the right direction in terms of pricing. But it's still a downhill ride unless the freight market can improve. A bit confusing that one, but you see how we've got a bit lower to go. So, conditions for a positive freight market. Well, Mahalis talked a lot about this, but very simply, just to reiterate the points, more demand than supply. And as Mahalis also said, demand is growing, but supply has grown bigger. At the moment, however, there is no real spare capacity. There's no layers to speak of in the market. And although slow steaming has shrunk fleet utilisation, an increase in speed will increase the fleet without necessarily needing new deliveries from the yards. This is a different take on the graph that Manali produced. This is, in percentage terms, demand growth and fleet growth between 2001 and 2013 and onwards. I'm sorry I'm not as good as the rest of my colleagues here. This is all my own work, so I haven't got nice little pointers and little dotted lines. This is just my attempt at PowerPoint. It summarises where we are and where we are going, I think. We see the first two mini booms clearly the blue line above the red line. From 2002, it took a long time to catch up. Post-financial crisis, while demand growth did not exceed fleet growth, but as it came from a negative zone, the effects on the market were still strong. 2013 to 14 is just a slight overlap. The future sees a large amount of daylight between demand and growth, supply growth, and the convergence is looking a long way off. Indeed, the supply side is not encouraging. There are a lot of ships to come. I don't want to press you any further, so I'll move swiftly on. But it's not just the ships that are already in the water, it's the space in the shipyards. Utilisation of global capacity is only 65% in the yards. There's still room for more ships to be built. Assuming no reduction of yard capacity with or without a Chinese whitelist, utilisation will be 59% in 2015, 52% in 2016. But even if 50% of the second-tier yard capacity disappears, which is a big if, global utilisation will still be 65% in 2015 and 16. Will this spare capacity lead yards to lower their prices further to tempt owners? And will owners be able to resist the temptation? Order book was boosted 2012, 2014 with all these factors. Lower prices, smaller order book, eco ships, new designs, particularly Ultramaxes, optimistic cargo demand prospects, new money. But I agree, PEQ is not only to blame, others all did too. And in fact, my view is that the new money, as we rather unfortunately call it, was actually acted as a catalyst and made other people jump in, rather than actually just being solely responsible for it. However, returns, which we were talking about back in 2012 for the future on these projects of 15%, look exceedingly optimistic now, and I believe we're moving back to lower prices after bouncing off the bottom just for a short while. And the future is challenging. As Mihalis said, 50%, 57% of the existing fleet is 5 years or younger. Scrapping is not enough to offset this growth. Underlying demand for scrapping is strong, but only 6% of the fleet is over 25 years old, and not all of this will be scrapped immediately. In my view, scrapping age would have to move younger than 20 years to have any significant effect anytime soon. The trade is challenging. Historically, trade has grown twice as fast as world economic growth, now only growing half as much. First time in decades that trade growth is slower than economic growth. And the global system is in fact going through a structural change that started well before 2008. And globalization, this big thing that's been driving everything, has reached a plateau. It has not come off the peak yet. The supercycle has always been about China. Growth has been stronger and longer and continued to carry on after 2008, only to start tapering off now. Even now, 7 to 7.5%, whatever it ends up as being this year, is fantastic. Indeed, only rarely have countries grown at super rapid rates in excess of 6% for more than 10 years. But once super expansion is over, the drop is 4.65%, which puts China growth at 4%, which is not good enough. Okay, this is a lot less than other people are predicting at the moment, but it's perfectly possible. And China itself is changing. Manufacturing is becoming less important. The demographics are changing. This, I think, is interesting. Okay, maybe I'm been reading too much, but the working age population in China, we think of China as being this huge place with a limitless amount of labour, cheap, easy. But no, the working age population, you know, the one-child policy in China, the working age population is now shrinking. It peaked in 2012. In other economies, Japan, for example, that peak of the working age population set things into decline. If you think about it, when people are working, they are able to buy houses and buy all the other things that a consumer economy needs. Property is 42% of steel consumption in China. When property stops, steel production stops, and dry bulk shipping slows down. Is China different? Okay. Yes, it is. It's big. It's more organised, controlled, let's say, than other developing countries, i.e. Latin America, Middle East, Africa. China's growth follows centuries of chaos and suboptimal growth, so maybe we're actually just witnessing the start of their real return back to medium. China's size alone creates internal economies of scale, which helps it to grow. If you look at what happened in America after the Second World War, it's a very similar pattern. Will falling iron ore prices stimulate ton-mile growth? Well, the figures don't look good. Growth will be 3% in 2014 and 2.7% in 2015. The steel price has fallen. As I said, 42% of consumption is used in property. There's a huge amount of empty flats. We think right here, there is China, 5.6 million properties unsold. Financial reform going on in China at the moment will limit any meaningful stimuli. Slowing growth in demand has coincided with a large increase in supply of iron and sent iron prices slumping. It's unclear whether iron ore price alone will trigger seaborne demand. Is the fall of iron ore a symptom or a cure? Coal. A lot been talked about coal recently. China is the world's biggest producer, but it's also the world's largest net importer. India exports are expected to grow to 300 million tonnes a year by 2020. Big numbers, but coal is dirty. And new environmental controls will reduce overall consumption. Look at what happens when now you even have the United States and China together agreeing environmental targets. Asian imports are likely to come from Indonesia and Australia, so not as many ton miles as hoped. In China, in 2013, China used almost half the world's coal. Import growth June to July in 2013 was 13.2%. It fell in the same period this year, 6.5%. Big changes all over the place. Prices are falling. Will this trigger seaborne trade growth? Who knows? What about the minor bulks? Well, you can see how iron ore, the kind of bluish colour there, has steadily grown over that period of time. You can see also how coal is up there as well. Yes, the minor bulks have grown, but not at the same rate. And all the rest of the cargo are pretty much there or thereabouts. Yes, there is growth, and emerging markets will always need this stuff. It's important. There will always be growth in emerging markets, otherwise they wouldn't emerge. But it's not going to be enough to save the day, in my view. Problem remains. Too many ships, not enough demand, cargoes. We are now witnessing, in my view, the start of a classic shipping recession caused mainly by shipping. Markets tend to kill themselves with oversupply. If history repeats itself, so George Bernard Shaw said, and the unexpected always happens, how incapable must we all be of learning from experience? But we do again and again, because this time it's going to be different. George. We go back to the graph. This is where we started off. Where are we now? Now, I believe, sadly, that we are not at the despair stage, not really at the capitulation stage. We're probably a bit afraid, but there may be a long way to go before things really start going. No one is running to the exits quite yet. There are no layups to speak of, and no widespread cancelling of orders. We are in a classic wait-and-see mode. The three words in the English language that sell and purchase brokers hate, apart from decline without counter. So is there hope? Or should we jump straight to despair? As my favourite composer said, when a man is in despair, it means that he still believes in something. And we're all here because we still believe in something. Peter Stokes at Lazard, I read in Trade News the other week, gave a very interesting view about the conditions required for a sustainable shipping recovery. This is a banker's view, and having worked for a bank for 12 years, I recognise his way of thinking. Ship prices must find a floor that properly reflects financial realities. Capital that was invested on unrealistic expectations must capitulate. Clearer picture of demand trends, particularly in China, must emerge. Interest rates must rise again. And commodity prices must fall to an established floor. Very nice in theory. In my experience, ship prices never reflect financial realities. Only in retrospect. After you've bought a ship, the market may match your expectations, but only after. The only time in my career that this has happened where financial realities matched the market expectations was in 2007 and 2008. And look what happened to those people that bought after that. Capital may or may not capitulate, depending on who is investing. Again, in my experience, wisely or otherwise, traditional ship owners are unlikely to clear out, whereas more corporate and financial-based investors will. That in itself will have interesting implications. A clearer picture of China? Even the Politburo. Look at the recent scandals in financing commodities in China alone. This is a continually changing picture. And interest rates may rise to stimulate growth, but it's certainly going to make a lot of ship owners uncomfortable at the same time. And you know my comments on commodity prices already. And I am doubtful that price, rather than supply and demand, is the prime influence here for shipping. So, as one of my heroes, and one of yours I hope too, once said, adversity is the first path to truth. So we are facing adversity, but this does help to clarify the mind. Obviously there's going to be investment opportunities, cheaper ships, and as we've said already, more choice. As the recession grinds on, I suspect there will be more ships available, both as resales and second-hand. The point is the choice will become better. Although the issue of eco-ships will become less important, the longer the oil price remains low, Japanese-built ships, especially with the low yen, will feature more as sales candidates, and there will be more resales of the newer low-consumption ships, especially from China, available as the penny drops that the expected returns will not materialise soon. So, to repeat once again, as I have done in previous forums, here are my 3 golden rules for shipping investment. Buy cheap, cyclically. Don't just buy cheap because it looks cheap, buy on the day. True, we're getting there. Buy what the charterers want. Not what you want, what the charterers want. Very important, because it's what's going to matter is not that you're going to earn more, is that you're going to be first in the queue to actually start it. Always have ships and... Okay. This is a case-by-case basis, and we can't look into how much money people have got and how much ships they've got and how much money and how much ships and how much ships. But the market's going to remain low for a long time. Don't go in a sweet shop getting lots of nice little ships, which you couldn't get before, if you haven't got money to pay for them. You will need money to pay for them. Greek shipping, however, I believe, has a competitive advantage. That's why I'm here. Oh, Patamara. Lost one. Only one. Greek shipping has a competitive advantage. It has a sense of history. It looks generationally, not just short term. It has a huge talent pool of expertise, energy, and innovation. It has an appetite for investment, and more importantly, an appetite for risk. It has, as already been pointed out, the world's largest concentration of shipping in private hands. Most importantly, it has always emerged stronger from every shipping recession. We are entering a critical period, in my view, in dry bulk shipping, which at best will be one of high volatility, and at worst a crippling recession. My suggestions, as a pure, humble shipbroker, concentrate on management, not on second-guessing the market. I think I'm repeating what's already been said already. Stay on the pitch and keep an eye out for opportunities, both in selling and buying wisely. It may not be what you want, but it may be the right thing to do. Keep the golden rules in mind, of course, and be flexible and decisive. And of course, when the facts change, change your mind. When will shipping rise again? Of course, I think as we've all agreed, no one knows, but it will. And the unique skills, history, perspective and talents of the Greek shipping community will make sure it will come back stronger than ever. In the meantime, keep calm.
There was another trap, and we ended up doing what we always do. But not everybody does the same mistakes, to be fair. Some people act differently, and they're the winners. And others act differently, and they're the losers.
Yes, and I also said earlier that I know how to manage this in that market. It's a good market that I screwed up.
May I have another question? Since we are this wonderful seminar organized by these excellent education providers, both the HMC and ICS, and we have the president here, Mr. Ogilvy. After what we have heard, I mean, at least myself at the end from SW Man, Simon, and of course I believe that everybody more or less says the same thing. How do you do all these young Greek people that they are coming into Greek city and they want to work in Greek city, obtaining all these hard studies, etc., certificates, diploma, degrees? How do you see that this young generation will be absorbed by the industry? How open is the industry to employ young people? This is the question.
It's not related to the subject.
It is. It is, absolutely. And I will tell you why it is. Because Greek city is regenerated for the last decades. And without young generation, we will not manage to go on and overpass into the crisis or whatever we are facing at the moment. And we have a requirement at this point of time, how we will have new names into the market, because as we have seen in any cycle, we overpass it and we have new names leading the city, not only in Greece, everywhere, but we need as well new people, and people is something very important, and it is within the subject.
I think the young people have already answered, because they will all vote the government that will make them all civil servants. So they've already answered. Because working in shipping is very, very tough, and it takes a lot of patience and strength and stamina. And can
We're
you
not
see
talking about the seafarers. We're talking about working in shipping.
I'm talking about everybody.
Yeah, I'm going to the companies in shipping.
So to who is
not seafarers? Mainly to all of them. I mean, although we have a problem with the shipbrokers that they are making in all over the world, and I don't know how they're going to cope, and I don't know how free it's going to be Simon to speak next year, but I wish he will be. But it applies to everybody.
Okay, Simon, would you like to answer the question, since you come from both worlds, the English and the Greek world, so perhaps you have an insight into both?
Well, firstly, I think it's a good thing that people want to come into shipping, don't you? Secondly, I believe that the centre of gravity in shipping as a whole is shifting towards Greece. The reason why there is consolidation of broking services at the moment is because the shit's hitting the fan. Commissions are down. There isn't the same investment banking returns that they could have expected a few years ago. And they are dressing up as being one-stop shops and, how can I put it, everything goes in the big places and consolidation is the big thing, but actually I've seen it happen, I've been around long enough to see it happen all before. Where did Braemar come from? Braemar came from Clarkson's. Where did Arrow come from? Arrow came from Clarkson's. Clarkson's goes through getting very big, and then it gets too big, and then, like the lever, little bits flip off. And I think that this is just another function of the cycle of the shipping market. I think things are changing because, in reality, the expertise and professionalism of which the ICS tries to promote here, of the Greek community, is becoming more and more significant. And that's why I'm here, both as an educator and as an owner of the company. I believe that Greece is professionalising. It is very well educated, a very cultured, and it has shipping in its DNA. And I think if Greece can gain the self-confidence, and Greek shipbrokers can gain the self-confidence than actually say we're actually better than London, the centre of traditional shipping.
Well, we've got all sorts here, so...
We've had no indication when it's going to rise again.
Tomorrow. I think it was clearly indicated that some people believe that there's a very long way until recovery.
Sure. I mean, who would not sort of invest for a time when he believed, that the market would be strong? So and that's what we did. That's what we did. An example of what I'm saying is what happened in 2013. We all thought that the recovery was around the corner, and we positioned ourselves at historically low value so that we wouldn't sort of miss the train, so to speak. It's always, and this is actually, if I like to say something optimistic, which I do like to say, is the recovery always comes when we don't expect it. And I hope it happens, sooner rather than later.
Can I be a bit more blunt in the response? I'm not telling you, and I do know.
I'll try and give it a